Welcome back to the Financial Flux with your host, Tobi. Understanding real estate market cycles isn't just theory, it's the bedrock of successful multifamily investing. Just like the seasons, the multifamily market moves through distinct phases, each presenting unique opportunities and risks. Today we're diving deep into the four key phases: recovery, expansion, hypersupply, and recession, and how knowing them cold impacts your acquisition and disposition strategies. Why is this crucial? Because mistiming your moves can cost millions, but perfectly executing your strategy within each cycle, that's how you build lasting wealth. Let's break it down. Phase 1. Recovery. This phase emerges from the ashes of a downturn. You'll see key indicators like declining vacancy rates. Properties start filling up as job growth stabilizes and demand slowly returns. Stabilizing or modestly rising rents. Rent concessions begin to disappear, and landlords might cautiously push rents. Limited new construction. Developers are still shy after the recession, so supply remains constrained. Increased transaction volume from previous lows. Investors, sensing a bottom, start to re-enter the market. From an acquisition standpoint, recovery is prime time for opportunistic buyers. You're looking for distressed assets, underperforming properties, or those needing light renovation. Deals can be found below replacement cost, offering significant upside. You're buying low, anticipating future appreciation and rent growth. For dispositions, it's generally not the time to sell. Unless you absolutely must, you're holding, stabilizing, and preparing for the next phase. Phase 2. Expansion, often the longest and most profitable phase. The market is humming. Look for strong sustained rent. Growth, demand outstrips supply, allowing landlords to significantly increase rents. Very low. Vacancy rates. Properties are consistently full. Increased new construction. Developers respond to high demand and rising rents, leading to more projects. Rising property values. Cap rate compression. Investor demand drives prices up, and yields become tighter. Robust job growth and population influx. Economic fundamentals are strong. For acquisitions, expansion means buying into a hot market. You're likely paying higher prices and facing fierce competition. Focus on well-located assets with potential for continued rent growth, perhaps through strategic upgrades. Value-add strategies can still work, but you need to be very disciplined with your underwriting and avoid overpaying. Due diligence on future supply pipelines becomes critical. Dispositions in the latter part of expansion can be highly lucrative. This is often the ideal time to sell mature, stabilized assets to capture peak valuations and significant capital gains before the market turns. Phase 3, hypersupply or peak overbuilding. This is where the party starts winding down, often subtly at first. Indicators include rising vacancy rates, new construction outpaces demand, leading to more empty units, stagnant or declining rents, increased concessions. Landlords compete for tenants, offering incentives like free rent periods. High levels of new construction deliveries. Many projects started during expansion are now hitting the market simultaneously. Weakening investor demand, slowing price. Appreciation, buyers become more cautious and cap rates may start to expand. Acquisitions in hypersupply are risky. It's easy to catch a falling knife. If you're buying, you need a strong thesis for unique value add, distressed opportunities, or extremely strong long-term market fundamentals. Patience is key. Wait for properties to hit the market from stressed sellers. Negotiate hard on price and terms. For dispositions, this phase can be challenging. If you didn't sell in expansion, you might be forced to lower your asking price or hold longer. Aggressive marketing, tenant retention programs, and strategic capex to differentiate your property become crucial. Avoid panic selling, but recognize that values may soften. Phase 4. Recession. This is the downturn marked by sharp increase in vacancy rates. Job losses lead to people doubling up or moving out. Significant rent declines. Landlords offer deep concessions to retain or attract tenants. Minimal or zero new construction starts. Development grinds to a halt. Decreased property values. Cap rate expansion. Investor interest wanes, and buyers demand higher yields. Economic weakness, high unemployment, decreased consumer spending. Acquisitions during a recession are for the bold, well-capitalized, and patient. This is typically when the best long-term buying opportunities emerge. As motivated sellers offload assets, you're seeking deep discounts, potentially focusing on stabilized assets in resilient submarkets or value-add plays where you can improve performance when the market recovers. Due diligence on financial health and tenant base is paramount. Dispositions during a recession are usually only for those facing liquidity issues. Expect to sell at a loss compared to peak valuations. Focus on minimizing losses and preserving capital. Often, the best strategy is to hold, manage expenses tightly, and ride out the storm until recovery begins. Understanding these four phases isn't about predicting the exact top or bottom. That's nearly impossible. It's about recognizing the indicators and aligning your strategies accordingly. By knowing when to buy aggressively, when to optimize, when to be cautious, and when to sell, you can navigate the multifamily market with confidence and build a robust, profitable portfolio for the long term. Thanks for watching. Don't forget to like, subscribe, and share for more insights into the world of real estate investing.